So this video is going to be kind of a response to people that are saying they're wondering if we're going to be in a bear market, and how do you know where there's a bottom? Are we going to bottom out here in the next couple of weeks, or is the NASDAQ, since it's down more than 20% and it's supposedly in a bear market, you need to guess, like, should you invest in a stock or should you not invest in a stock right now? Because there's a potential that we go down, we double that, we go down 40% over the next 6 months. Or you're guessing and you think it's going to go up in there. So I see all these videos about bear market and just not knowing where we're going to go from here. And this video is basically going to explain how you don't have to guess on that. That is totally irrelevant. And it's a mistake if you are just catching a falling knife on any of these stocks right now. And I'll admit that I made a mistake on SoFi. I caught a falling knife back in December, and I'm paying for it big time. And I knew this too. I don't know what I was thinking back then. I just figured I kind of threw out my my rules out the window and just decided to average down in the 14s and the 15s, thinking, oh, it fell from 24. It's gonna bounce back here soon. And as you can see, that's not the case. We're at $8 now. I mean, I sold some of those positions, like I swung some of it, but I still have shares that are from the $15 range all the way up to $17 range. And I've averaged down a little bit, but I think my total average right now is like 14 something. So I'm down significantly on that. But if I would have followed my own principle on this, I wouldn't have to worry about that at all. And it's pretty simple too, because you don't have to guess if it's a bear market or not. And you can use this both ways if you're going to be short or if you're going to be long. I'm guessing most people watching this video are going to be long, and so for this it works. If you're trying to guess the bottom, you don't have to worry about it. Let's do an example here. I'm pulled up Lucid here. Well, first of all, it should be good to know a little bit of Elliot Wave. I recommend the book 5 Waves to Financial Freedom. I'll put the link down in the description. You can check it out on Amazon. It's like $10, and he just goes over pretty much all the principles of Elliot Wave, what waves 1 through 5 do, what are the normal retracements. He goes into like the structure of corrective waves versus impulsive waves, everything you need to know for Elliot Wave. And that's basically all you need to know is the basics of Elliot Wave. You can get really in depth if you're trying to like day trade or just hold a stock for a couple of days. But if you're trying to invest, you don't really even need to know more than what the 5 waves do. And here's my response though to people like trying to guess if it's a bear market or not, which technically it is a bear market now, but guessing to see if your stock is going to go down another 20%, another 50%, or if it's going to rise here soon. The only thing you need to do if you're trying to be long is wait for a bottom. You wait for the bottom. You don't try to, even if your stock is way oversold, like I can show you so many different stocks that are oversold on the weekly time frame. Let's see, Lucid is not oversold on the weekly time frame, but on the daily, not either. This isn't the best example for an oversold stock, but here's the general point. If you use Elliot Wave, like here we have 1, 2, 3, 4, 5, and you're trying to guess the bottom, well, you wouldn't have bought in on any of this, because you would have said 1, 2, 3, 4, 5, and then you would have had B. And let's say you did want to buy in here. You saw this big bounce from 33 all the way to 47. Well, if you didn't catch the falling knife and you bought in on the 50% retracement, so you bought in at 40.70 or 39.11, and then you put a stop loss below the low, So let's say it was 40.70 you bought in, and you bought, I don't know, 1,000 shares. So you could lose $7,000 if it broke the low of this, which it did. So you get stopped out there. So you've lost $7,000. Your average was 40.70. Now you've lost $7,000. So here, we can just type that out. You're down $7,000. So you're negative 7,000 right now. So the stock keeps on going down, and if you would have held it right here, you would have been down another $12,000. And instead of $7,000, you're down. You would have been down $19,000. And let's say you decide not to catch a falling knife, and then right here it bounces again. And you're not sure if that's a first wave or what that is, so you decide to buy in on the 50% retracement again. So 50% retracement right here at 25.35, you buy in, and it goes down again, and you are still in it because it has not hit your stop loss. It bounces, you're pretty much even, and then right here, which actually was today, you get stopped out. So 25.45, and you bought 1,000 shares again, you lost another $4,000. So now you're down a total of $11,000. So you got negative 4,000. So now let's do the math. You have 11,000 you've lost, but if you would have held from 40.70 all the way down to where right here where we're at right now at 21.49, so 40.70, 21.49, you would be down $19,000. So $19,000. So you saved yourself $8,000. And that's not even knowing Elliot Wave, because if you knew Elliot Wave, you wouldn't have entered right here because you would have known that's a fourth wave. You wouldn't have entered right here because you would have known that's a B wave. And if you did enter at the bottom of this, you would have already sold. So this is without knowing Elliot Wave, just knowing that you're buying back on a retracement at the 50% or 61% retracement, and then you're stopping out below the low, you would have saved yourself $8,000 just on that, instead of just holding from here all the way down to 21.50. That's the general principle. So then right now you're stopped out and it's going down. You don't know when it's going to bottom. You're not going to catch a falling knife, and let's say it bounces again, and then it pulls back for the second wave, and you buy in on the 50% retracement again. Eventually, you're going to hit the bottom. I know, like for this downtrend, it's insane how long it's gone on for, but eventually you're going to hit that bottom, and it's going to pop for a third wave, and then you're going to be doing just as well. You're going to be doing better, actually, than you would have been if you were just holding those shares at 40.70 or whatever we bought in at up here. It's going to take a while to get back to even right here, but you saved yourself $8,000, and I mean, depending on the time frame, you might not have a wash sale if you waited more than 30 days, which technically doesn't really matter that much. But you saved yourself $8,000. You saved yourself a lot of money. You didn't have to guess if it was a bear market or not. You just waited for that bounce and then bought in on the 50% retracement with a stop loss below the low of the origin of that bounce. And so that's basically it. It's really simple, actually. You don't have to guess the bottom. You don't have to do any of that. You don't have to throw your money into a falling knife. All you got to do is wait for the bounce, and once the bounce comes, wait for the pullback, buy, stop below the low. And you're going to save yourself a ton of money doing that. And then eventually when you hit the bottom, you can just hold, and that's a lot better strategy than just holding all the way up here from 40.70 and just being like, oh, I'm a long-term holder. You can still be a long-term holder, but you still got to be smart about your entries. And then once again, this right here isn't probably going to happen. You're probably going to have way less losses too, because you're going to know exactly where a good bounce is and where a possible first wave is, rather than just getting in on these random bounces that look like a fourth wave, So that's basically my response to why you don't have to guess if we're in a bear market or not. Of course, it's smart to know the trend too. Like, you are going against the trend when you're catching these 50% retracements. So maybe if you want to go short, it'd be better since we are in a downtrend. But then again, when you're at this level right here, it's not a bad thing to start trying to go long, and then you can figure out the bottom using that simple strategy. So I just wanted to go over that because that will save you so much more money in the market, making smarter entries in the long term with your investing, and you can use it with any trading too. I mean, I use that for day trades on SPY, on many different things. It will save you so much more money, so much more money. But then again, also you got to make sure that you learn Elliott Wave first, so you're getting a first wave. So kind of a longer video, but that's probably one of the most important principles of Elliott Wave that will really help your trading out. I can't think of very many more that would be more helpful, because you don't even have to be that good at Elliott Wave to just know this. Because I just see people averaging down, and then the stock keeps on falling, and then eventually they get so frustrated that a lot of times they'll just sell. It's better to keep your cash and have a smart entry and exit. So let me know what you think in the comments. I highly recommend that book that I mentioned earlier. That will really help out your trading, just to learn Elliott Wave. But like and subscribe, and tell me how you are entering your stocks right now in this supposed bear market we are in here on the NASDAQ. All right, I'll talk to you in the next video.